To me, as a long-term investor, Tesla stock is so undervalued still. And Guru Focus also thinks that Tesla stock is way undervalued. They think that maybe it's not a perfect buying opportunity like it was back in December here, but that it is still a wonderful opportunity to load up on a lot more Tesla shares. They think that back in 2022, it was a bit overvalued, but you're still a little far away from these levels, so maybe buy Tesla stock is basically the message that I'm getting from them. In the short term, of course, Tesla could still drop a lot, but in the long term, to me, it looks good. Guru Focus just published this article on Yahoo Finance, so let's see why they think Tesla stock is so undervalued. As of July 28th, 2023, Tesla stock price stands at $265, while the Guru Focus value, an estimation of the stock's fair value, is at $448.91. This discrepancy prompts a deeper analysis of Tesla's value, integrating key company details with financial assessment. Basically, they are saying that Tesla stock should already be at $450. In other words, buy more Tesla stock as long as you can buy under that price. The Guru Focus value is calculated based on three key factors: historical trading multiples, a Guru Focus adjustment factor related to past performance and growth, and future business performance estimates. The long-term return of Tesla stock is likely to be much higher than its business growth because, based on their calculations, currently Tesla stock is trading under its fair value. In other words, even though Tesla stock returned more than 100% gain year to date, Tesla's deliveries, for example, did not double year to date compared to last year. Before investing in a company, it's crucial to evaluate its financial strength. Companies with weak financial health pose a higher risk of permanent loss to investors. Key indicators like the cash-to-debt ratio and interest coverage can provide insights into a company's financial strength. Tesla's cash-to-debt ratio of 3.97 outperforms 81.27% of companies in the vehicles and parts industry, indicating strong financial health. One way to look at this also is they are saying that Tesla is more like an auto company than a technology company, but yet it is still grossly undervalued. I personally see that as a great thing because there's so much more opportunity still. And you can see how much Tesla has in cash and how little debt it has here in red. This, of course, is important. Comparing a company's return on invested capital, ROIC, to its weighted cost of capital, WACC, is another way to assess profitability. ROIC measures how well a company generates cash flow relative to the capital it has invested in its business. WACC represents the average rate a company is expected to pay to finance its assets. If ROIC exceeds WACC, it suggests the company is creating value for shareholders. Over the past 12 months, Tesla's ROIC was 24.6, while its WACC was 19.8. There's also a little bit about Tesla's profitability and revenue growth, which is very high. And then in conclusion, they say Tesla stock appears to be significantly undervalued. The company's financial condition is strong, its profitability is fair, and its growth ranks better than 97.36% of companies in the vehicles and parts industry. Maybe that's because Tesla is not an auto company, because it's a technology company primarily, really, based on its future earnings. Every single good investor is going to look at the future to predict what the stocks are going to do instead of looking at the past, seeing what the company has already done. In other words, it is true that until today, most of Tesla's profits came from selling cars. But in the future, most of the profits will come from selling software, for example, full self-driving, and also a meaningful amount of profit will come from Tesla's energy storage business. So that's why I say look at the future and not the past. One of the top Wall Street analysts, Dan Ives, who is also a Tesla stock bull, says to read this thread on Twitter. It is written by Tom Lee. He is a managing partner over at Fundstrat, and he has been top ranked by Institutional Investor every year since 1998. This will help us understand overall our stocks overvalued, and it will also give us another way to value Tesla stock. Many say that markets are expensive because the PE ratio is 20 or higher. One may not realize this is ascribing anchoring power to an abstract concept. Price to earnings ratio is between price and earnings, and each of these has an entire field devoted to each. Technical analysis is all about studying the price, and fundamental analysis is all about studying the earnings. Technical analysis looks at patterns, models, and systems to determine probabilities of path of price. Note that technicians do not care about earnings. And earnings, really, that's one thing that all I care about in the future. Equity analysts study and model earnings. I used to be a technology analyst covering wireless. These analysts model future earnings and then calculate the present value of future cash flows. Understanding the above, this is why this PE concept is way more abstract than many realize. Which earnings should we use? Today's earnings? Earnings from 2024? 5 years out, perhaps? And then what about the market? Which earnings does the market care about? In many cases, it cares about the next quarter a lot and maybe the next year, maybe a year after that. Which is why I try to understand how much Tesla will be making 5 years from now, 7 years from now, 10 years from now. And then once we get to 2030, market will actually start caring about 2030. Right now, the market does not care about 2030 as much as it does about next year when it comes to Tesla. And that's really where the opportunity lies for us Tesla stock investors to take advantage of this opportunity. Moreover, here is a fact. So one says S&P 500, the 500 largest companies in the US, are expensive at 19x. He's talking about the PE ratios, and should be at 16x. Ask, how many times in 75-year history did S&P 500 trade exactly at 16x? The answer is only 1% of the days, maybe even less, he says. Now, if you look at the historical mean of S&P 500 since 1871, it is pretty much 16, and the median is also very similar. It is 15.24. But looking at macrotrends.net here, often stocks trade above 16, significantly above 16, although a lot of the time also, if you look at the past, the stocks trade well below 16. But if it trades under 10, it really doesn't stay long there. The stock market recovers, relatively speaking, fairly quickly. For S&P 500, keep in mind this is comprised of 500 companies. Should each of the 500 stocks trade at 16x? He says, has this ever happened? Nope. And which earnings also? Nobody agrees. He says that PE matters, but it is really abstract. He continues, and this is where you want to pay close attention. Benjamin Graham is the father of value investing. He's the person who Warren Buffett learned a lot from, and Warren Buffett talks so much about Benjamin Graham. His formula for price to earnings is this. 8.5 is the base PE plus 2x expected earnings per share growth. So for example, S&P 500 grows at 7 to 9% per year with buybacks. This means 8.5 plus 14 to 18. So he took 7%, he doubled it, that's how he got 14. He took 9%, he doubled it, that's how he got 18. And then he adds 14 plus 8.5 and he gets 22.5. And he adds 18 with 8.5 and he gets 26.5. We can also apply this to Tesla. I'm going to borrow this chart from Yashu. He was on Brighter with Herbert. And you can look at Wall Street's expected earnings per share growth for Tesla for the next 3 to 5 years. It's supposed to be 25%. That's the Wall Street consensus. Then we take 8.5. Remember, that's the base. Then we want to add 25% growth. I'm just going to round it to exactly 25%. And we're going to add that twice. And we get a fair Tesla price to earnings ratio of 58.5. But this is assuming that Tesla will only grow at 25% per year. Now, Tesla is guiding for 50% year-over-year growth in delivery. So do you really think that Tesla will only grow its earnings by 25% on average for the foreseeable future? Here's data from macrotrends.net, and Tesla grew its earnings per share at 676% from 2020 to 2021. Then it grew it by 122% from 21 to 2022. And then for 2023, so far, it is a 27.9% increase. Keep in mind, this is with huge, enormous price cuts. This is before the release of the Cybertruck. This is before the release of the next generation vehicle. This is before Tesla upgrades all of its factories. So let's say Tesla grows at 38% per year. So then we would start again with 8.5. We add 38 twice, and we get a price to earnings ratio of 84.5, which would imply that Tesla could easily still go up from here, at least a little bit certainly. Tesla's current PE ratio is almost 76. So if we follow that same formula, we can also reverse engineer and see what the market thinks right now Tesla is going to grow at if we follow that formula. So we start with 8.5. Remember, we are reverse engineering, so we do the opposite here. And then we just divide this number by 2, and this number is the percentage by which the market would expect Tesla to grow its earnings by, basically. 33.71%. That number certainly does not sound crazy to me, and that's just one way to double check if the stock that you are buying is not grossly overpriced. And let me share one more way how this formula can be incredibly useful. So remember back in December when Tesla stock dropped close to $100 and everyone was panicking? Well, you just need to ask yourself this question. What is Tesla's price to earnings ratio? And at the lowest point, Guru Focus says it was at 30.23. That's a low price to earnings ratio. We just follow the formula. Again, we reverse engineer it. So we go with 8.5, and then we divide that number by 2, and then that means that the market at that time thought that Tesla will only grow at 11.36% in terms of its earnings for the foreseeable future, and maybe perhaps even in the long term. That was so absurd to think that Tesla would only grow its earnings by under 12% per year. That's why I bought so much Tesla stock back in December. And YouTube says you should watch this video next, but if you haven't finished watching this Elon Musk interview, watch this one first. My name is Matt Pocius. Like and subscribe if you haven't yet, and I will see you in the next video. Thank you so much for watching.